morning, good afternoon, or good evening, everybody. Thank you so much for joining us today in the 28th edition of the CVC Insider Series. This week, we have a great session ahead together with Kirsten Bartok, founder and managing partner at AirFinance Ventures and president at New Vista Capital and New Vista Acquisition Corp. Kirsten has an incredible career and story spanning startups, strategy, private equity, and corporate venturing. But before we get started, I wanted to quickly set the stage so you all have some context. First, my name is Alba, part of 500 Startups. 500, we are one of the world's most active seed stage investors with over 2,500 direct investments into startups from 75 countries. And within 500, I work closely with corporate investors and innovators to power their own projects, initiatives, and investments into startups. We started this CVC Insider event series as part of our efforts to help raise the bar in corporate venturing and build a stronger, more supportive ecosystem for startups and investors alike. And every 2 weeks, we host this roundtable featuring some of the world's top corporate venturing practitioners and sharing their unique journey into CVC, specific challenges and best practices that they've learned along the way. And our host, Nicolas Sauvage, will be moderating our discussion. But there's also a Q&A function, so feel free to ask any questions that come up along the way, and we'll do our best to cover. So now that you know what's going on, I'm going to hand it over to Nicolas to take it away. Enjoy.
Thank you, Alba. Thank you, 500 Startups. This is really an important initiative for everyone in corporate venturing or thinking about joining corporate venturing to learn the best practices from the best. And today, Kirsten is a very accomplished corporate venturing expert, let's call it what it is. And I'm really looking for hearing all the learnings that she has collected along the way. Kirsten, if you would be able to, I can see you already have an interview in parallel happening. If you could maybe spend 5 or 10 minutes to share your personal journey into corporate venturing and what was useful along the way. Thank you.
Sure. Nicolas, I appreciate being here. I'm excited to talk with you today. And I'll give you a good span of corporate venture capital, as well as having been both the seat in corporate venture capital, as well in financial venture capital, and kind of the back and forth and how they relate. So I entered, you asked me to go a little bit further back. So I guess I grew up in an entrepreneurial family, was always entrepreneurial in that aspect, and then attended the University of Pennsylvania and majored in economics and political science. And there definitely got exposed to the world of finance through the Wharton School and classes I took in that world. And after undergraduate, decided to, was lucky enough to get a job at Goldman Sachs in their investment banking program. So spent a few years in their corporate, in their investment banking division, and then also in debt capital markets, and found that I really enjoyed the finance aspect of corporate, of investing in businesses and corporate, and how that, how essential it was, capitalization and growth to a company's progression and long-term success. So after Goldman, went on to business school out west to Stanford Graduate School of Business, and was lucky enough there, being in the heart of Silicon Valley, it's hard not to be exposed to all the interesting things happening on Sand Hill Road in the world of venture capital and the explosive growth happening in technology. So focused there for 2 years, with definitely an emphasis on venture investing and technology investing, and spent a year at Broadview Capital. They had a venture firm in their arm, again, kind of another corporate venture, but within an investment banking firm. And then after business school, went and worked for Hamricht and Quist at their venture arm. We had a $350 million, I would say, mid-stage growth equity fund that was doing kind of, at that time, which was still early, Series C and Series D venture rounds in technology startups. And H&Q, again, for some of those who may not be as old as I am, was kind of the three horsemen on the West Coast at the time: Montgomery, Hamricht and Quist, and Thomas Wiesel. I'm blanking on the third, which is awful that I forget it now. But they were really the three boutique investment banks that catered to the technology startups And it was I joke, it was kind of the wild, wild west in the late 90s when I got there. And there was a lot of collaboration between investment banking and investing and research, which probably wasn't as fully allowed as it would be today. But at that time, we were hearing, and the investment bankers were out recruiting, looking at early stage companies, and we were doing thematic investing at the time. The internet was just taking off. It was 1999. So spent a couple of years there, and I had a wonderful mentor, Charlie Walker, and he was fabulous and helped guide me. And again, one of the things you learn about investing is that it truly is a mentorship business. That it's hard to learn on your own. It's hard to learn from the corporate side, but you really need to get that apprenticeship from sitting on boards, understanding how to structure term sheets, and really learning by doing. And that's what we did there. So after a period of time, we actually got acquired by Chase Capital and Chase, the big bank. And that we became even more of a corporate venture capital firm, where we were able to look at fintech and technologies that were being incorporated into the bank at the time. Today, as we look at fintech and crypto and all of that, it was just starting in the early 2000s. But it was really core and central to where Chase was going. And we were able to test out technologies that were taking off at the time. And this included, of course, middleware, because we were really at the advent of the conversion from the server-based software to cloud computing and the migration out to the edge, which we would see kind of come to fruition over the next 20 years. I laugh today that at having such a long-term perspective in technology in the venture world, and things I'm seeing in my world today, I do mostly emerging technologies in aerospace, defense, space and communications, logistics and transportations. But things I'm seeing now have so many similarities, because there were many investments we made back in the early 2000s, which would eventually come to fruition, but we just were too early because, let's say, the middleware wasn't there, the processing power, the edge computing, the computing power that people would eventually have in the palm of their hand with their iPhones. Or other devices that really drive a lot of the technological innovation that we're seeing today, whether it's on e-commerce or internet or all of the above, that we invested in a lot of companies that were too early. And now 20 years later, they are mainstream. They're how everyone behaves. And it's funny to have that kind of perspective looking back in the rearview mirror of how things would have evolved differently. So I think the other thing that having started so early gave me was that it also has perspective. Like, you have to have a long time horizon and understand that this may not all occur in the next few years. And that has really helped me as we think about, okay, what are the building blocks? What are the technological infrastructure that needs to be created to have the vision you see in your industry come to fruition? After Chase, I went to a middle market kind of private equity, growth private equity firm, which is doing more focus on, I would say, companies that were making money still in the software and services industry. It's called Alpine Investors, and they have since built a really strong business in the growth of the software space in companies that are profitable in that sector. Spent a few years there, and then, funny enough, had the itch to move into the operating role. I think, while venture capitalists are popular, it's really in Silicon Valley, it's really the operators that create much of the value. And until you have operating experience, I always hate to say I love venture investing. I obviously am a big fan of it, but there is some perspective that they are the parasites. And I don't want to use a negative word, but that they're the ones giving you capital, but then the operators are the ones doing the hard work and heavy lifting. And I think it is essential and valuable to have seen both worlds and to have a position in both. So I ended up starting a company called Exojet, which was a next generation fleet operator on the business jet side. So really a business jet airline, was taking a lot of things they saw in NetJets and other fleet operators that they thought they could improve upon. Had invested in there and served on the board for a year or two. And then later, about 2 years later, came in as their CFO. And that was having been on a board seat. I certainly had perspective of how startups work, how boards function, which is essential, an important part of helping companies grow. And then being able to serve as the CFO and understanding how the back end, how you scale an organization, what is important both from a fundraising perspective, but also an operational perspective versus FP&A, accounting, whether it's 409 valuations, and really running a ship and going through audits, which is an essential part of building any company as well. So did that for a few years. And then we ended up selling a majority of the company to TPG, Texas Pacific Group, as our partner, and left there kind of to think about what my next trajectory was and where I wanted to go. Was lucky enough to partner up with an individual named Bill Boyster, who was kind of a luminary in the aerospace and defense industry, having built Gulfstream and had worked at NetJets. And he had been recruited into Hawker Beechcraft to do a turnaround there after the 2008 financial crisis, trying not to bore everyone. And I went in there to help him work in corporate development, structured finance, and strategy. So it was great to kind of be his right-hand man. Or how do we recapitalize this company? Again, taking things I learned from the Goldman years and then built on how do we correctly capitalize this company? How do we do fundraising? How do we create strategic partnerships to right size this company? Ultimately, we were not able to recapitalize and get the debt down. So we merged with Textron after a bankruptcy proceeding, which was frustrating, but also another good lesson in boardroom politics, which I would, one of my first mentors said to me early on, and I forgot to mention, neglected Nancy Fund, who was also integral with Charlie at Hammerich and Quist. The mentors have said, you learn the most on the downside as a venture capitalist when you have an investment that goes wrong. And of course, it's an expensive proposition, but that is where you learn the most about how to protect yourself on the downside, how to protect your investors on the downside, and then how to take it from there. And sometimes how boardroom politics mean that the most optimal solution, or what you think is the most optimal solution, doesn't actually happen. After Hawker Beechcraft, got the itch to go back kind of on the operating role, but combine my venture investing. So with another partner, Tom Lowe, started up AirFinance. And that is a credit fund that focuses on doing credit investing in large assets in aerospace. So again, once again, kind of taking a domain expertise, a venture approach, and starting up a company. So since then, we've built about a $1.5 billion business in the credit side of investing. And that's been really successful, working actually with private-public partnerships and groups like XM, UKF. About 5 years ago, we started watching the trends happening in emerging technologies in aerospace and defense, and kind of being in Silicon Valley, as well as having this kind of traditional aerospace. I would say I'm the bridge between Silicon Valley and the old world. We started looking at the changes that were happening here and started to invest on our own, predominantly at the seed and the Series A round, but where we thought we could add value, where we thought our specific expertise of combining the worlds of the traditional general aviation OEMs with the new technologies that were coming on. And we've actively expanded that over the years to do more with space and communications as that comes into propulsion, and then logistics and transportation as it relates to large assets. So to finish the story, about 6 months ago, we definitely, as you look at emerging technologies in aerospace and defense, they tend to be deep tech. They tend to be asset intensive, highly regulated, and that takes a unique type of investor as well, a little more capital intensive. So we then partnered with Dennis Muhlenberg, the former CEO of Boeing, and created New Vista Acquisition Corp and New Vista Capital as an investing vehicle for these 4 sectors in emerging technologies. So we went public in February of last year, and we are still actively looking for a target for our SPAC, but also working on private capital investing. So doing kind of, again, later stage investing, I'd say Series C and Series D investing for the emerging tech in aerospace and defense. Sorry, that was so long, but hopefully that gives you a long span of kind of the multiple things I've done over my career.
I'm sure I'm not the only one in the audience thinking, wow, there is so much to unpack. I'll start from your financial background, and you clearly have the education, but also a lot of your career is based on finance and working for the best banks, the best companies that work in that space. How much of that makes you a better investor? And how much of that, especially I'm thinking early stage investment, where actually you don't have all the financial data like you would have for a public company, and how much of that could potentially bias you, where you could miss a good company because the finance is not as good as what you would like to see?
I think you bring up a good aspect. For early stage investing, certainly technical expertise and understanding the landscape and having a thesis on how the trends and area are going to evolve is more essential. And then you're making bets at those earlier stages. I think where the finance side can be very valuable is, for example, in asset intensive industries. And as those companies grow, helping them think about how they're going to capitalize themselves, as well as how they're going to capitalize their customers. And that is a unique kind of value proposition that we bring to the table. You know, one of the things I know we're going to discuss is, look, you can be an investor, but you have to differentiate yourself. So how do you do that? Is it through your connections, your expertise, your domain expertise, which is extremely important, your connections, your ability to help that entrepreneur network and leverage themselves. But it's also bringing new concepts and thinking to what that entrepreneur. So what we've seen in aerospace and defense is that most of our entrepreneurs are tech, that they come from Silicon Valley. They don't necessarily have deep domain expertise in aerospace and defense. And we can bring that in because of our deep connections in that industry. But the second part is this is an asset intensive industry, and how you sell these investments, how they are capitalized by your customers. Even in Solar City, if you look at how you capitalize service-based businesses, if you're not going to sell your equipment like an OEM does, but you're going to operate it, you need to think about your capitalization differently. So while it's not necessarily as important from an early stage perspective, it is important as you get to like Series A and Series B, because at that point, you really need to have your business model more thought out and how your customers are going to acquire and how you're going to operate it. And I think what you want is always to be able to bring something differentiated to the table and help your entrepreneurial partner, your operating partner think differently and be additive to his or her experience and background.
I think this is the first time of all our interviews where we have a zoom on capital intensive startups whose customers will also need capital. And so I want to double click on this because I feel like there's a few golden nuggets here. How do you help the startup that you invest in to think well ahead of the game, to plan for their customers, to know how to capitalize well, to operate?
It's a great idea. And we're having that balance in our industry. If you look at where the commercial aerospace industry is coming, you've had someone who makes the equipment and someone who operates the equipment, other people who maintain the equipment, right? And then you've got the customers. And as Boeing or Airbus or Embraer, you don't own the customer. Your customers are the airlines, but then the people who fly on that are over here. Well, as we think of, and I really, what I try to do to, again, create value and understand thematically where I want to go is take from other industries. So one of the things that has been incredibly successful is full stack companies owning the rails or owning the roads and bundling, right? So as we look at our industry, we've stolen concepts and ideas and business models and tried to apply them to, again, our emerging technologies in space or emerging technologies in aerospace. As we have these new types of vehicles that come out, drones or passenger VTOLs or whatever they are, the combo of the two, cargo, how are they going to be operated and how does that look like? And when you're in the seed part of creating a company, you don't really need to figure those out. Sometimes in Series A, you don't, but you have to have a better answer when you visit investors. But by the time you really get to A and B, you've got to have figured out that business model. And of course, it all matters because every entrepreneur is asked about the TAM. So what is your TAM? And you need to define, well, am I selling my equipment? Or am I operating my equipment? And in both cases, because of the large footprint, the large, whether you're talking about a drone, it could be $1 million. We're talking about aircraft, it could be multiple millions of dollars. These things are not, as we talked, they're capital intensive and they're expensive. So your customers, you either need to raise debt capital to operate those, and that is a much cheaper source of capital. It's not venture debt. Venture debt is different, but it is debt capital that's available in structured finance or secured that can be significantly cheaper and less dilutive. So those are opportunities, and how you leverage those, your business model is a function, and you need to make a decision one or the other way about where you're going to leverage those capabilities. So I do think as we think about asset intensive, as we think about operating models, that there is a lot that just I uniquely have to add in that value. I'm not going to tell you which is the best. I'm not the person who's going to tell you, oh, I don't like that wing position or how you've done the flutter, or gosh, that M gauge, or that's not my area of expertise. But I do bring the concept of business models and integrating and being able to look at multiple different worlds, whether it's general aviation, helicopters, business jets, commercial aircraft, UAVs, to, the full stack we see in the tech world. And that is essential at that level.
if I try to use an analogy, your job is to make sure there's enough fuel in the plane so it doesn't crash too early and it can get to the destination. And the reason
also that they have a flight plan and a good flight plan, you know. So
exactly, a good flight plan. So the reason I ask is it's not just aerospace. We have clearly a lot of tailwinds in Cleantech. Clearly, a lot of people are looking at investing in Cleantech. A lot of projects are going to be capital intensive, including for their customers. How would you guide an entrepreneur between owning and operating versus selling? And here I really want you to think about, is there parallels or differences between Cleantech and aerospace?
Oh, there are so many parallels. And I think the other part is, again, this is the benefit of age. You know, I lived through the downturn and the having Cleantech investing blow up and not to those companies not coming to fruition, to not being able to live up to their hype. And that is, and you hate this, but that's always an overhang on an industry, right? And weighs people down. So I think what we're trying to do is think of new innovative models. You could say to some extent, the time has come again, whether it was the infrastructure that hadn't been built up that caused the delay in these, but we're just now seeing the fruition and a recognition, both back to the corporate model, that having a plan for large corporations is one, matters to your investors, it matters to all your stakeholders, which is the word we should use. And management teams are being held more accountable as to what there is. So to some extent, you always had clean tech or green tech is a hot siloed. It was just on its own out there. But now you're seeing a greater integration to the rest of the world, and everyone has to be a clean tech company. What is your green, what is your carbon neutral plan going forward? And it's been wonderful to see that trend in the last few months. And again, the traditional industrial world recognizing that. Now, coming back to your earlier question, how does that relate to business models and how that should work out? And you know, we all come into biases. I think it's recognizing in every place that we come into biases. You saw something work here and it didn't work there. I think what we have learned greatly is that to extract value, to really have decent margins in an industry, you, more than just having a moat and having a unique differentiator, to some extent you have to have the ability to not be disintermediated. And how do you do that? It's and differentiate. It's not just having a better product and a mousetrap, a better chip that you have to continuously renovate, but it's also owning the rails and owning the customer experience and being a better operator. Now, inevitably, full stack companies are more capital intensive. And they require, they're more detailed, and sometimes they take more time and years to nurture, because you're not just building the product, you're then building, you know, the roads in which it operates. And we're seeing that in clean tech as well, that a recognition that you want to, if you don't want to get disintermediated by people who can do it cheaper than you or do a Me Too product, you really have to add value in some other aspect of the value stream. And that's good. Look, I also think that we're seeing that flywheel we talk about increasing in rapidity, that is happening as you get the tailwinds in the industrial world that we speak about, a recognition that everyone needs to be thinking about decarbonization, that everyone needs to be thinking about carbon neutral. And how do we incorporate those emerging technologies that are happening in our industry so we get involved in that? And hopefully we see the world converging, right? Instead of just going on along in linear parallel lines.
I was interviewing two VC veterans about what's the difference between Cleantech 1.0 and Cleantech 2.0. You've described it really, really well. And I think the fact that the Fortune 1000 companies now are really becoming customers, not just talking about it, but not acting, is a big deal. Mm-hmm. There are two things you're saying about operating, which I think is really important, which is the rails and owning the customer experience. And it nearly feels like if it's a business which has very high capital intensity and requirements, actually owning the customer experience becomes an advantage that it was capital intensive. It means it probably means the barrier is higher for customers to even try. Can you tell us what guidance you would give to entrepreneurs? They've decided to go into a capital intensive area. They are deciding to operate it. What should they think about customer experience? Because that's maybe not obvious when you start to own the full chain.
True. It's a good point. And the other tough part, which whether you look back at Silicon Valley and traditional hardware, or you look back at aerospace, because it's both the same, we've often had engineers who don't really experience the product in the end, design things. And we had that problem more in business jets because the people designing and putting out weren't necessarily the users of it. And you've got to have both ends and think far in advance. And I think one of the toughest parts of having a startup or doing investing is that you've got to be thinking multi-stages further out and kind of understanding where the ball is going. And if you're going to make a mistake, it's going to be because your estimation or your guess, your thesis about where that momentum is going, that trend is wrong. So instead of going left and owning the customer, you decided to go right. And that is the benefit. I remember when I was first entering, I was 26 and entering the venture capital world, I was like, people would often say, oh, you want a venture capitalist with experience. You want them with productive. And I would make an argument, no, you want someone who's not on 8 boards, who has more time to devote to you and can do heavy lifting. And candidly, you want both, because there's value to both types of investor coming in if you're an entrepreneur. But you do want someone who's lived through cycles. You want someone who's lived through multiple business models and can use some of that hubris, that experience to spot trends and help guide you. And in the end, the entrepreneur is always the final decision maker, the CEO of that company. But that person's job, whether he or she needs to take input from multiple places, and the greater diversity you can get from that input, the better. So back to your question about capital intensive industries, I think you need to be thinking far out. And if you don't have an understanding of how business models that have succeeded or failed, if you're a drone company and you can't inform yourself by the chip industry or DJI or the robotics in 3D robotics or companies like that, or how Boeing and Airbus and Embraer all worked, or you need to be able to inform yourself and kind of have that historical perspective, just as you're a battlefield commander, to know what has worked in the past and what doesn't. So again, to your point, I can't tell you what company you are and which path to take, but I certainly want you to be the funnel in which all of that information is processed and then makes the best decision and creates a cogent argument on the other side about what is the best, path and approach to your market that you have.
I'll push the analogy where the entrepreneur, the CEO, is the captain of the plane, and you're helping him decide on the optimum flight plan with enough fuel and knowing where to refill.
Yep. And you're
Very
providing
nice.
the information and they make the decisions. Absolutely.
Very nice. And I think we should be very careful not to think that we can make decisions for them. Absolutely.
So true.
You mentioned, and I really like when people do that, you mentioned you had a mentor, Charlie Walker. Can you tell us maybe 1 or 2 things that you learned from him that you still use today?
I did Charlie Walker and Nancy Fund, so both, but they were fabulous, and they really gave. They recognized that it was an experience-based industry, that just having high intellect wasn't going to make you. And there's 2 different parts of being a venture capitalist. 1, being a good investor, and then there's 2, helping your company get to fruition and being a good board member and advisor, because that's effectively what you are. So in one sense, it's kind of it doesn't require the extroverted technology. It's really an introverted, research-oriented, understanding trends and what's going on. But then 2, to win that deal and then to work in a boardroom, those are the interesting thing about venture capital is it requires, like a CEO, multiple different skill sets that don't always fall within the same person. And they were both very thoughtful about laying that out and kind of explaining how to do that. And they were incredibly considerate about allowing people to taking the time to spend time with the people they were nurturing to help bring up in the industry. And not everyone has time to do that. We joke about venture capitalists not always are the best managers, because sometimes to be a good investor and to be a good board member, it doesn't always mean you make time to mentor and nurture and develop the talent below you. And they both did a ton of that. So I am incredibly I think you can never go back and not be appreciative of those mentors who gave you an opportunity to invest and an opportunity to make mistakes, and to not berate you when you make mistakes, because we all make mistakes, and it's how you handle those mistakes and how you handle yourself and take responsibility for those. And, I hope I spend time doing that today, but sometimes in our busy world, we don't make enough time to, work with people and help nurture their careers. So good reminder.
And Nancy is extremely impactful and successful at DBL Partners, triple bottom line. It's very lucky when you have mentors that are so good.
And she's a great example of someone who identified a trend early and worked with it. And I give her so much credit for that. After we were at H&Q, and she really identified the double bottom line, that we can do good investing and give back. And that really led to, green tech, clean tech, and she went off in that direction. And she was really one of the first people to do that. And then to do it successfully over the same fund in multiple years. You haven't, as we talked about earlier, you had a lot of the mistakes that, and this wasn't their fault necessarily, but the industry went through many bumps in clean tech and green tech investing. And Nancy has been able to sustain her investing, produce incredible returns, and continue on that path. So she is, it also highlights what someone can do when they get an expertise early on. And I would encourage any person who wants to be an investor that you do need domain expertise. You do need to be clear about what you bring to the table, and it must be differentiated, which is why we talk about generalist venture capitalists are not very valuable. And you really need to be focused. And that's sometimes why corporate venture capitalists does work best, because you yourself are an expert in that vertical, but then you get a large, big company behind you who can be an early customer and provide validation, which is compelling.
I think you're leading me nicely into corporate venturing and the advantage of corporate venturing. But one thing I like is you just mentioned domain expertise. And if I look at your career, what you've done is build a number of domain expertise and then decide how you find the intersection between multiple of them. Is that something you would recommend people, which is to try to pick up 1, 2, or 3 domain expertise, or just focus on one?
That's a great question. And I think so much of life is happenstance, but it's also about how you react, right? So I made a pivot into aerospace. And funny enough, until electrification and autonomy came around, aerospace is pretty boring. You could look at the aircraft, and there was not much difference between the aircraft of 50 years ago and the aircraft of today. So I had, but once I started to see changes occur there, it was able for me to make the connections back to Silicon Valley times and what was happening. So I do think, so with that, I would encourage people to lean in, to become domain experts. When I mentor our younger people, and they talk about everyone's in a rush, right? They want to move up fast. The way to do that is to develop a domain expertise. And, I remember when I first noticed that autonomy was happening, well, I didn't know automatically everything that was going on in the space or distributed propulsion. So what I did is I leaned in. I spent all my extra time. I was interested personally in it. And I would spend all my time studying it, meeting with companies, talking to people I could. And you've got to devote that time. You have to. I didn't go to the gym as much as I wanted to, as much as I probably should have, because I was studying this area of expertise and developing my own knowledge in that area. And so you have to sacrifice for that. But I think it's very difficult to win if you don't have a domain expertise and you don't develop. Now, having said that, you have to be able to pivot too, right? So if you see your industry going off here or there, you need to kind of be able to adjust. So people who were clean tech, who were batteries or energy, or, we see this. Are you a battery expert today? What is the area that you know better than everyone else? Because you always have to be thinking about how you provide value. Again, I'm going to show my age once more. We had Andy Grove, who co-taught a class at the GSB when I was there. And you go back to only the paranoid survive. Like, you can never rest on your laurels, whether you're an Intel or whether you're a venture capitalist. And you've got to always be evolving your talents to keep up and making sure that you, one, know what's going on in your area, but two, that you can add a differentiated value.
This is a huge golden nugget for everyone. Actually, whether you want to be a VC or an entrepreneur, or
exactly,
that's true. And in a way, so one of the challenge, and I think you mentioned about Nancy being right about trends before they are obvious. And in a way, if I think about VC or CVC, you're making bets on the future that's not there yet. And you're going to be very successful if you see the future as it's going to become. And many times when I talk to different VCs, they have a view of the future that's obvious to them. It's just not obvious to everyone else. And people talk about contrarian view, but it's a contrarian view based on very deep conviction. When you talk about this flywheel of building your domain expertise, which in a way is linked to passion, how much of that could be dangerous where it becomes such a strong bias you can't see alternative futures?
Well, I actually appreciate people who are in CVCs because I think they have a unique perspective. My inherent bias is that, and everyone has a different perspective, so I throw this out there as a controversial, but through my experience, I found it very difficult for large companies to innovate and evolve. So I just think that the mindset internally, the risk aversion, there's so many reasons we can point out. And you see that even in Silicon Valley today, that you see Google and Apple and the companies like that being acquisitive. When they really acquired innovative technology, it hasn't traditionally occurred internally, it's externally. So I personally believe the same thing applies in aerospace and other industries, or certainly in aerospace. But the benefit is that you internally have so many domain expertise and you have people who will speak to you. So let's just use, a CVC at a large industrial company in aerospace and defense. You have experts in so many different emerging trends that you can learn from those people. You can understand where they're going. And what you have the benefit of, you can also see where young companies are taking it, and you can bounce those ideas off. And you can, in your almost a silo or in your own island, develop your own thesis, which probably doesn't always match internally unless you've got a really thoughtful, innovative senior leadership team, and many do. So I don't want to say that out there. But the benefit of that CVC is both internal and external, that you can inform the ideas of the senior leadership team, and hopefully you're a part of them because you're seeing trends in your industry and you can help guide them as to where to go, whether it's an acquisition or just a minority investment. But it's also on the outside in terms of you can watch, I'll laugh at this. When I first started looking at this space, I'd worked at an OEM who certified aircraft. I knew the problems. I'd worked with many OEMs who'd certified aircraft and knew the timelines. And I spoke with many people in the VTOL industry who were needing to get FAA certification. And they would tell me their estimate of timelines. And I didn't want to be rude because I really respected these people, but their timelines were completely off. They weren't based in reality because they just weren't fundamentally informed about how long an aircraft takes to get certified. So you, to some extent, can be, again, that bridge between those two worlds of maybe the people who are too risk adverse internally and maybe the people outside who are maybe too optimistic about how fast things. And so it's an incredibly valuable and important and interesting position to be in.
And you could argue if there was no such tension, then the CVC is not playing a role. At the end of the day, it only matters if you're starting to influence, and hopefully positively. It's funny you mentioned VTOL because you invested in Elroy, I invested in Autoflight. So clearly we believe in the same future where eVTOL is going to be there and contributing to society. Let's move towards the direction of a CVC. At some point you mentioned that your company was acquired by Chase, and then you made the comment, and we became even more of a CVC. Can you tell me why you said become even more of a CVC?
Absolutely. And I think this is what really gave me the strong insight. So so when we were at H&Q, we effectively used the brains of our bankers who were trend spotters and were awesome in whatever vertical they were in. And that's how we partnered together. And it was a really powerful model. But when we worked as Chase Capital, they really recognized that as a customer, which is what a CVC can do, that they had a lot of value to bring to the table. And that certainly, as we talked about the cybersecurity, fintech, and again, that was very early, that they could really accelerate. It was storage capabilities. It was data centers. I mean, things we were looking at that Chase as a large bank would be a user of. And that was an insight to that about how powerful that can be. Because if that large corporate is an adopter of those technologies, and that's really how Chase looked at it, they can accelerate the development of this company that you have a strong thesis in. But if you're not getting any traction internally from your buyers, whether it's your IT department or your data center department as a customer, or your, and fintech is a little different because we can all agree that the banks relate to that. But if you're not getting traction internally, that is also a recognition, just back to the fundamental of the dog's going to eat the dog food. So I did realize and appreciate the power of having a big corporate as a buyer and a tester of technology behind you. And we had not used H&Q in that way when we worked together on the venture side.
Financial VCs are very clear about what they're about.
Yes.
And they have ideas about some value add, but they are not claiming to have anything from the mothership because there is no mothership behind. Right. Although sometimes they have LPs that can be helpful. Yep. But corporate VCs come with a promise, explicit or implicit, there is a mothership behind. And if they don't deliver anything to their portfolio companies, would you say that it's actually even worse than a financial VC?
I think in the old world, you could have said that. But I think, again, as I talk about everything rapidly evolving, the SPAC is a new product. There's a bunch of, I do think that what happens is while we've had Kleiner Perkins and Sequoia and Excel, as strong investors, they provide a halo effect on a company. I think that what we also see is that, certainly in my sector, if you have the corporate venture capital arm investing, that is also a recognition that we find this technology industry interesting. We think there's potential, and it does, certainly when you're in deep tech and in hardware, does convey some authority and power to that company. So I'll give you an example. So we, in our emerging aerospace defense, they aren't really buyers of the technology. They may be suppliers, which is what we see more often, that they're providing technology. And you wouldn't necessarily have to say that a supplier has to invest, but it certainly is a good housekeeping, or, to use another nomenclature, of a sign of approval if you have a strong company with deep tech bona fides in that area, that they are putting money into a company. So I do think there, again, the directional value may be going the other way, but it's, again, a new twist on how we're seeing corporate venture capital work and in the ecosystem.
Very nice. So you mentioned about SPACs. I think I have two questions. One will be about AirFinance, but before that, I am extremely worried about SPAC, not because they are not good. I think some are exceptional, but you have poor actors, people who did SPAC without adding any value or intention to add any value to the companies that would de-SPAC. And there are statistics and proof points that if you have an operational based SPAC, people with real operational background, they outperform. And my view is that actually they perform as they should, and it's the other SPACs that actually underperform and should not even be in the business. Maybe I'm being provocative, but do you see these two camps, or do you have even more granularity in terms of quality of SPACs we see today?
So without denigrating the SPAC, I think we went through a period of time in which every banker and their brother could create a SPAC, right? And there really wasn't a screen necessary about the high quality people. They were expecting that the bankers, the investment banks that were taking these management teams, sponsor teams public, were expecting the companies on the other side to be the screen. But there were some people who said, okay, I can be a cannabis SPAC and I'm going to invest in space. Two parts. I would very much hope that what we did see is that PIPE investors, hopefully, and that was not always the case, would see through that and say, I don't think a person with a cannabis or healthcare experience is going to be a great investor in space. That didn't necessarily happen, which is unfortunate. I think it's happening now. Again, we're kind of in a dislocation in the PIPE market. So if we were at the peak, we're now at the abyss, and hopefully it'll normalize again. But I do hope that entrepreneurs, we talked to some companies who really didn't think, who only wanted the money that you had in cash and trust and didn't think that the insights of the sponsor team had anything to do with it. When we came to the market, I do think we had seen the same research you had and said, look, if you really want to add value, and took a venture capital approach of your money, but you need to add value. And if you want to differentiate yourself and create a long-term differentiated vehicle and platform, you have to add value. So how do you add value? And we had our 4 focus areas of aerospace and defense, dual use technologies, space and communications, and logistics and transportation. And we put ourselves in each of those and said, who would be the well-known executives in each of those areas that we would want on our board? And we were lucky enough to partner early with Dennis Muhlenberg, and we all used our connections to attract some of the greatest operating talent, so that if you were in logistics, if you were in advanced durability, if you were in space, we had the team that could open any door for you, that could help you avoid minefields and really assist you. And that is only shown true. What we do as a unique vehicle, again, we are focused on our areas of expertise. We know what they are. We know what they're not. And we also recognize that we engage with companies earlier, even if they're not looking to be a SPAC, because we think to companies at the Series D and Series D level who are thinking about going public long-term as mentors, as people with public company experience, as people who've scaled operations, who've built large-scale manufacturing, who've handled the regulatory environment, that we can add a lot. And so we have started to engage with earlier companies that we think are high potential, that may not be a SPAC, and whether that's through a private round or just saying, look, we like you. We respect what you've done. We respect what you've built. If in a year or 2 you'd like to work with us, let's start to add, we'll give you some of our free add value, consulting now. So I think that the SPAC product is a valuable tool in our tool set. We've always lacked crossover investors. There's never been a deep pool of them. And for the Series D and E rounds, that's valuable. And also having a group of people who can mentor and nurture and assist a company as they make the transition to a public company, that's valuable too. What we need to do is make sure that you have those tools, that the people who are the sponsors of those organizations actually have those tools to bring you as a company and are adding value, and not just handing you the cash and trust.
I think the way I would see it from the entrepreneur's point of view is, if you're not demanding, you're going to get what you don't ask, which is just capital and nothing more. And you really should be demanding. You should be hoping for a dream team, like you mentioned. You handpick the right people that can really help you. You're looking at people that are building a platform to accelerate your dream. You're looking at all of these things beyond capital.
We've encountered people who've come in with an arrogant view, who say, no, we are all set. We don't need anything. We don't need anyone. So how much of your promote can we take? How much of your ability to get out in a material adverse change? And we went to those people being like, oh my, that's not really the partnership approach. That's not really the values-based approach that we believe in, that we want to, again, I'm sure you tell people the same thing. Is you go into a transaction as an entrepreneur, you better like who you're partnering with. You better think they have the same values you do, because you're effectively married to them for a long time. Yep. It's the same as a SPAC. You two are in this together. And you better have aligned values. You better have a chemistry and a melding of the mind, and see the future in the same direction.
It's the same as interviewing people. You want to make sure the fit is both direction. You have to make sure of that.
Absolutely.
So tell me more about AirFinance. Not too much, of course, but enough to say what it is that in your design you were very thoughtful about to make sure you had, and what you thought was not important.
It's so interesting. So AirFinance provides asset-based financing to customers. We started with a partnership with the U.S. Export-Import Bank to provide U.S. companies, whether you're software or manufacturing, whether you're making MRI machines or services or aircraft, and to help non-U.S. customers buy those products. We then partnered with other governments, the Canadian government, the UK government, the German, the Italian, to do the same for their domestic-made exports, I should say. So we spent a lot of time in emerging markets and a lot of time working with companies that, have different, and that is tremendously fun, because it's so interesting to learn about different cultures and different approaches. One of the key things that we and XM and we've also expanded into infrastructure financing, so roads, hospitals, as you build those in developing nations, but have tried to do is really look forward thinking about where the US industrial base is going. And again, it is a little more services than manufacturing. We want more manufacturing. We're going to encourage more manufacturing, but we're going to lean in a bit to services and what the US sells. And how do we support US companies, whatever they sell, even if it's not hardware, could be software, and provide support to those buyers outside of the US to make sure that there's a level playing field globally, so that you're not competing against a Chinese company that is given with government support, so that your playing field is not equal. So again, I think that is something that in the industrial world, it's relatively well known and understood about how this support is available and how you think differently about asset-backed financing, hard assets, than you do. But in the technology world, it isn't. And I hope that we have a mindset as we think about the multiple, as venture debt has become more the norm than it used to be 10 years ago, that both asset-backed financing or services financing to support your sales will become another tool in your toolkit that entrepreneurs can use. And again, what understanding about the competitive nature of things, what we've realized is funny. When we started the business, back to your question, we thought our expertise was aircraft, funny enough. We thought we knew aircraft, and this was what we did. And we realized what we knew is we understood about how to engage with government agencies and how to help emerging companies engage with government agencies, because there's a language difference just in terms of how they... Yes, again, it's sometimes translating between those two organizations. So which is why in the end, our business expanded to not just aircraft, but outside of aerospace, but to really the areas that the government was interested in investing and what they cared about, and taking our business in that direction and looking for and partnering with companies and help them partner. So that private public partnership. But again, it goes back to, you've got to be flexible in this world. I encourage every entrepreneur to have a plan, to know exactly where they want to be in 5 or 10 years, but then they have to be able to adapt and adjust. And it probably won't look in 10 or 5 years like you thought it was. But if you can't adapt and adjust to the competitive environment and what you're seeing and what you're hearing from customers, then you won't be successful.
So let me follow on your last statement. It looks like aerospace is taking off like a rocket. But you also mentioned you need to learn from the downsides, what happened in the past. However exciting it looks today, 5 years, 10 years, what it is that you're thinking about from what you've learned from the downsides. What are you doing differently than if you never had downsides in the past?
In any situation, you've got to constantly reassess what you've learned through a process and what you didn't know before. So for example, we are much better. We know now what it takes to if I'm speaking about the SPAC side, what it takes to put a pipe together. And we're taking a very different approach than we did 5 months ago, of finding an acquisition target and putting a successful pipe together. And with everyone, regardless of how old you're going to get, you always wish you knew today, or I wish 6 months ago I'd known what I knew today, but you've got to adapt and adjust and take those learnings and make sure you disseminate that learnings and not just not adjust your path. With that, I think there are, as having gone through a bankruptcy before or taken companies or having board fights, anytime that I think about how we structure things, either at a company we're working with or partnering, or looking at internal dynamics or how the industry is, you take those insights and you take those learnings on the downside that are invaluable. I know it's not very helpful, but again, I can't remember, it was Nancy or Charlie once told me early on, you only really understand what every term in that underlying operating document or agreement is, and when you go through a liquidation or bankruptcy, because in the upside, you never see what those terms are. So that's when you really understand, oh, that's how that could protect me on the downside. So we hate to go through them, but you're not going to be a good investor or good operator unless you've been through that.
I think I haven't gone through that, and I can feel that I'm going to learn the hard way about this.
It stinks.
Absolutely. The way I look at it very simplistically is sponsors decided of a SPAC. Sponsors decided to sponsor a SPAC without knowing exactly what it's going to be used for. But the pipe investors, they know exactly what their money is going to be used for. So for me, the proxy the biggest proxy is really the pipe investors. And then the worst signal, of course, is sponsors deciding not to to leave, which would be really a disaster. But pipe investors, for me, is really the signal that this is going to be a SPAC that's likely to be successful. And I want to have a feel from you about, is it about checking who is the pipe investors, or is it the size of the pipe versus the SPAC itself of the sponsors? How would you tell people to look carefully at the pipe to have a good signal, a rich signal?
So, Nicolas, I 100% agree with your statement. However, I think because we're in such a difficult pipe environment, is not necessarily apropos anymore. So okay. I said the same exact thing you said, 5 or 6 months ago. I said, you want to follow the pipe investors because they were the ones who were able to see some inside information and really get time with management and make some astute decisions. Unfortunately, I think that wasn't always the case because we had a hyped up market with a lot of retail investors who were bidding deals up. So, most people understand that a SPAC is based upon $10 book and trust value. And then if it goes up to 12 or 14 or 18 or 30, in some cases, you basically get some frenzy around there. And as we've seen, and this may be a simplistic view, the Robinhood traders kind of step away and the retail trade really pull back. You haven't seen the uptick in a lot of really strong deals. So it is no longer black or white anymore. It's just, and you have to be more discriminating. So I do think that I've always felt that if you see a strategic investor, so corporate VCs in a deal, that is a big deal because that is also people who have hardcore industry and tech knowledge, and they are putting their money where the mouth is, and they can see the trends. I think the same as you've got some institutional, but the problem is, and it's an interesting question, I can't give you the answer. Once this bubble goes through, those overvalued deals that occurred in January and February go through the de-SPACing process, will there be money to refresh in pipes? One, we don't know that. We hope that there will be. But two, because deals are not trading up, what we're hearing from institutional investors is, why would I want to lock myself up for 4 to 5 months when I can just buy it in the open market at 10 or 9? I used to be willing to do that because it would trade up to 14 or trade up to 18. Yep. But if it's going to trade at 10, there's no upside for me investing in a pipe. So I actually wonder if SPAC 4.0, or maybe we joked that it was SPAC 2.0, maybe 3.0, whatever we're at, that the next version is, it will include maybe less emerging companies. There were some companies that went public too early, and that was a problem. And it will include smaller pipes. You will not see that. So I would expect that you have lower expectations for round sizes, and that you spend more time with investors really educating both sponsors, so SPAC sponsors and companies, really educating their investors so that they, and creating more reasonable valuations so that the redemptions are lower than we're seeing today. So again, thesis, as valuations come down, as we get more reasonable views, because you got the hangover, we will become a more normally functioning market again.
Looking beyond the abyss. So I have one final question, which is not looking what you knew 6 months ago. What would you advise Kirsten 20 years ago?
That's a great question. I think the most important one is do something you're passionate about, because everything requires sacrifice. There are always other better things to do. And if you don't enjoy what you're doing, you won't make the sacrifice. And I remember at business school, and I did to some extent make a wise decision. I was thinking about going to the hedge fund world because I really liked the markets and I liked investing, but I didn't love going through registration statements or S1s. That wasn't my passion. And I watched friends of mine who it was their passion. But I really love working with companies. And as I've talked about, I love diving into the intellectual curiosity of diving into a sector, understanding all the companies in there. That's something I would do in my free time. I would do if I were retired. So do something that doesn't feel like work. Do something you're passionate about, because you can do it for a lot longer, and it doesn't necessarily feel like drudgery. So I think that is the number one thing. I would say that my last little one, which I probably wish I'd done, is that finding a job that doesn't require travel definitely allows you to have a more balanced life and family. I will say that. I have a job that requires a ton of travel. It's a global industry. It is so fun. You get to meet people. I mean, the aerospace industry it's not one country focused. You got to be everywhere. But certainly if you're balancing a family, sometimes that is a tiny bit easier. So if I look at my software friends who are CEOs of software companies or tech companies, they're like, they don't have to travel as much. It's very basic. They're, some for sales, but that'd be my last little, but definitely do something you're passionate about because the rest will follow.
Kirsten, that was fantastic. We learned so much from you, and I love the way you're ending it with passion. Thank you.
Nicolas, I really enjoyed our conversation. You're an excellent interviewer, and I look forward to our next one.
Thank you. I look forward to meeting you face to face very soon.
Yes, me too.
Bye.
Oh, bye.